Okay, right. Now we mentioned about they give you a overview of the type of ETF. Okay, I think the slide, sorry. Oh, today I have really a bit of a technical issue with my apologies, right? We got to backtrack a bit. Okay. After the video, now I just give, sorry for all the earlier disruption, right? It give you a overview what are ETF. I'll just repeat that for the benefit of those who have been not so much be able to earlier on can capture that on the video, right? ETF basically are passively managed funds. Yeah, it's like mutual funds, right? But these ETF are basically passively managed and they are known as tracker funds. In other words, they basically established to track the performance of certain indexes like the STI or SP 500, right? What does it really mean, right? Give you an example. If you buy into a fund, right? You say, okay, I want to buy into top Singapore corporates, which means, okay, the Singapore banks, maybe the government-backed companies like Keppel, SIA, Sembawang, or even like Singtel, CDL, Venture. These are all good Singapore stocks, right? So if an investor wants to buy into these top counters, he can also buy into, go and find a mutual trust, right? Or mutual funds where the fund managers will cherry pick which are the good, even among all these good corporates, which are the shares they want to buy. And they use that your money in that fund to basically try to get the best return, right? By investing in or choosing the top Singapore corporates. But for ETF, if you want to buy this into the top Singapore corporates, instead of getting to a fund manager to cherry pick, you can just buy into a STI ETF, which means to say that if the STI, which is basically representative of the Singapore stock market, right, it move, your ETF will move in the same direction, right? So the composition of that fund, right? Basically, I invested in the same type of shares of the STI, right? The Singapore Stock Straits Time Index. So it moved in the same direction, right? So in other words, the fund manager don't have to do anything. It's just basically try to invest in this, not try to invest. Basically, they will invest in the same counters that basically constitute the Straits Time Index, such that you will move in the same direction. So it is passively managed, right? And for that also, because of that, you pay much lesser fees, right? And ETF basically, most of the time are open-ended investment funds because it can actually issue more shares such that the investor can buy and sell the ETF, that particular ETF, right? Because closed-end means there's only limited shares. It's fixed already, right? Then it depends very much on the demand and supply, in which case it may not necessarily be able to reflect clearly the trend of that particular index. Okay. And ETF basically, unlike mutual funds, are traded on the stock exchange. Okay. So, and today, because of the popularity of ETF, more and more people are buying ETF. They, instead of being passively managed, as I mentioned earlier, fund managers also have switched to be CTF to become more like thematic. You want to invest in high-tech funds. You want to invest in emerging market SMEs, right? Invest in gold, invest in whatever, semiconductor companies. So it's thematic and it became also more actively managed for which, of course, you pay a slightly higher fees than just purely the tracker funds, the traditional ETF. Okay, so I've more or less repeated what is mentioned on the slide video earlier. Don't worry, right? So fees are charged according. Do you see the same screen as I read out? Let me know. The screen should be what are ETF, right? Do you all see the same screen?
No, no.
No, wow. I have a technical because okay, just give me a minute. I may have. Now, do you all see the screen?
Yes.
Maybe I have shared just now on a kind of a different screen. But you hear my explanation, right? Which are all listed here. So please turn on the video. I mean, I have a little problem today with the slide posting. So now you got the right screen, huh? What are exchange tradable funds? The few key points that I mentioned to all of you, right? Okay. Stop me again if it's not the case. Okay. So open-ended is a tracker fund. It is also can be actively managed. Fees are charged lower than unit trust mutual funds because ETF are passively managed. And it can be cash-based or synthetic, which I will explain later, right? What is actually cash-based and what is synthetic, because there will be slides on that. So for those who are not familiar, even if what is a stock market index, right? Because we say they track indexes, right? Is ETF. What is basically a stock market index? Stock market index example very clearly, a common one is the STI, Straits Time Index, for those in Singapore. Of course, globally, you have many others like Nikkei, S&P, Dow Jones. These are all indexes. So an index, market index, is a statistical measurement, right? Comprising a representative basket of security in a stock market. So it reflects a certain numeric value and also useful for illustration of a change in price or the value of the stock market. Like STI. STI basically have 30 counters, right, of the stock exchange. So it represents about 2/3 of the stock market composition. So it's a good reflection of the trend of the stock market. So today, STI is about 3,002, right? If we go to 3,003, that means generally all these 30 stocks in proportion would have moved up. But when it come down, that means the composition of these 30 stocks will come down. So this basically, like what here's it mentioned, it reflects, right, the change in price and the value of the stock market over time. Okay, so ETF basically will also try to track the same movement of the index if it is basically designed, right, to track that particular index, right? So this is a good example of STI ETF. STI ETF. There is STI ETF. You will later on. I'll show you the the uh, SGX screen, right? They can actually make use of that, right, to go and look for the STI ETF, right? Here is an example. On top is the STI index 3,218, right? Maybe that was some time ago because we already put up this slide, right? STI, basically, you look at the chart below, right? It should trend, right? The same direction and movement of the STI. So maybe in a smaller proportion, 3.267. So if next day you go to 3.3, this STI ETF will also go to around that 3.3 level, right? If it's a good tracker fund, then it should track very closely, not exactly, but very closely to the trend. So that's why it's called a tracker fund, right? So what are the observation of tracker ETF, right? So basically, you see, in stock market, in the short term, stock market can be very volatile, especially 6 months to 1 to 2 years, it's up and down. But over the long term, in the longer term, generally the stock market is that, yeah, it generally should rise over time. You can look at many indexes, right? Both Singapore and overseas, right? In the longer term, basically with inflation and all, you pick the right stocks, right? Generally, it moves up over time. So for long-term investors, so some of them are saying that, well, instead of me trying to choose cherry pick and then trade in and out, which is very difficult, even for professionals, right? Basically, why don't I just buy, if I'm a long-term, I buy into a ETF that basically would, and you hold out and it rises over time, rather than you pick the wrong stock and some of which can give you, cause you to lose a lot of money, right? So that's why many investors, basically, they will look at it. If I want to invest in Singapore and next year, let's say, example, again, doesn't mean it will be the case. 2025 will be a good year for Singapore economy. Is it me going to cherry pick which are the good counters? Of course, it's good because if you pick the right one, I just don't need to waste too much of my time. I buy into the STI because STI will reflect the general trend of the Singapore economy because take 2/3 of the STI counters are basically reflective of the Singapore stock market performance. So you buy into the ETF, if you believe the trend is as such, and you don't have to go into deep research, and you also pay lower fees to the fund managers because it is passively managed, right? But of course, like I said, because of the popularity of ETF, now there are over 13,000 ETF listed globally and ever increasing. Now, in fact, many fund managers find it's more attractive now to make it become actively managed and charge a little higher fees. I mean, not that I again advocate you all to go into such high risk investment. Please be mindful. If you have read the papers about cryptocurrency, right? Those who are interested in Bitcoin, Ethereum, you see, in the past, you have to go directly into it, and it is very volatile. You don't know also which one to go for, right? And also how to get into platforms that could be very risky. So subsequently ETF was also developed by funds managers to invest in crypto, for which they will manage the trend. So if cryptocurrency were to go up or Bitcoin will go up, you just buy into it, right? Into their funds, it will also rise in tandem. But again, I always like to qualify, Bitcoin, crypto are very, very risky. When you invest in it, you can actually lose all your money because basically it is a very volatile, and up to now, it is still not something that is really endorsed, right? Because it's not a legal tender and all. So because I want to make more mention to it, but I use only the ETF as an example that those who are not familiar, they just buy into the ETF, right? So understanding ETF funds. Now, let me play the video again. Again, I appreciate, just let me know if it's not working well, huh?
Types of ETFs. There are many types of ETFs available to investors.
Okay,
They can be broad-based, in which case the ETFs will track major indices that represent entire markets.
sorry?
Some examples would be the STI, which represents the Singapore stock market, and the Dow Jones Industrial Average, and the S&P 500. Type.
Yeah, what is that? Sorry? Nothing heard. Is that nothing heard? No noise?
Got sound, but no video.
Oh, no video again. Okay, I think because the video maybe is not so good, so let me just go on without the video because I will repeat that again. Huh? Otherwise, I just don't want to create all this disruption. My apologies. Right now, okay. Just now when I thought on me, I was trying to play the video, but it doesn't work. So the video today is not working well. So okay, now I just repeat what is on the video. The type of ETF, theme and strategy. Right? There are different types of CPF. The broad-based equity ETF, the one that I've explained to you all earlier, that basically track indices. So up to now, what I've said, anyone have any questions on this tracking of tracker funds that ETF basically track indices? You want me to explain or repeat? You can put in the chat box. Anyone have any questions? Don't worry, you know, be small group, so you can just post your question in the chat box, or you can actually put on the audio and ask me. I mean, it's a benefit for all of you, right? Those who don't really understand. But it's, yeah, before we move on. So you have different type of EPF. The first is broad-based equity. Secondly is broad-based fixed income. ETF also been set up to track bond indices. That means if you want to buy bonds, you don't know which one to buy. You don't want to buy a specific bond, right? Maybe it's government-owned company bonds, or especially those corporate bonds. You don't know the risk, right? You can actually buy into an ETF that invests in top rate bond, right? And here there are also indexes on bonds, for which therefore you can also buy ETF on bonds. I will show you some of the next examples later, right? And there are also like sector and industry ETF, right? On banks, energy like gold, right? You want to buy gold, oil, luxury brands. They have also such themes, such thematic ETF that if you believe gold is going up, then you look for the gold ETF, SD, PF. Again, it will be shown in the later slide, gold in ETF. So instead of some of them having to go buy physical gold, you just go buy into a gold ETF, for which the movement of the gold price will be the same, right? Reflected in your ETF. This is how you go about it. Even oil, as I said, or global or regional. If you think a certain market is going to do well this year, Japan market, India market, then you buy into that India market top corporate ETF, which will be a safer bet, right? Rather than going into the SMEs in the particular market ETF, right? So it can also go into region or globally, like global tech stocks. You can buy, you like global tech stock, then you look for the ETF that invests in global tech stocks. And specialty as well, there's also things like golf club ETF, you know, those golfers can also buy into such specialty ETF or high yield stock indices, right? REITs, all this, you can also, instead of investing in specific REITs, you can buy in the REITs ETF where they will pull in various type of REITs, right? Give you a certain return. So some are based on indices that which they are trying to track based on the performance of the indexes, right? Where they choose the particular REITs, for example, or now where they are actively managed one, then the fund manager will be a little more active to select the various type of REITs that give you that desired return. Okay, so these are the different type of ETF. Okay, here that's where I want to show all of you, right? If you go into the SGX website, okay, and you go under, very simple, you type SGX, right? Then you go into security, right? And when you click on security, then you go to the ETF screener, right? You get basically list out result, right? And in that, you will list out a number of ETF. That's not all, but I'm just showing only the Singapore, listed on the Singapore Stock Exchange, right? Like what I've mentioned to you earlier, you want to buy into the bond ETF, right? You have the ABF SG bond ETF. Then you can also go into other high-tech ETF, uh, like technology, and C-Tech is a technology, China, stars and China's ETF, Gold Singapore ETF, right? So you can actually go in and you click on any one of them to find out basically what this ETF actually invests in, right? So later on, I will also explain to you how to look at all these parameters on the right side in the later slide. But this is just to give you a brief, right? That you want to find out on ETF in Singapore, just go to the SGX website, go under security, click on ETF screeners and they will appear, right? And then you can start searching. Actually, you can search by name also, right? And also if you want to look at it globally, you can go into the website and say, oh, ETF, high tech on US, right? They will also show you which are the ones, MSCI, let's say high tech ETF, right? Then later we will also explain how do you look for information on this particular ETF. Like in Singapore, I mean, this one I just cherry pick, I mean, and show you maybe a little bit outdated a few months ago already, right? The ETF in Singapore, which are the more popular ones, right? Increasingly more popular. SPDR, STI, ETF. This is one like what I said, that they basically just track the STI performance, right? Uh, and expense ratio is actually reflective of the cost, right? How much do you pay? Yeah, eventually, the lower it is, the better, right? Because it's passively managed. That's why the expense ratio is very low in the case of SPDR, STI, ETF, right? Then you have you want to invest in the Hong Kong, China's tech companies like the CSOP, the second one, I think, Lion OCBC Security, Hang Seng Tech, US dollars, right? Those are one you can explore more detail. Even here, gold is also very popular because people want to use gold as a hedge, right? They can, instead of buying physical gold, you can buy into the gold ETF, or you want to buy in the high yield bond indexes, right? High yield Asian based company instead of buying into specific bonds, right? So STI ETF, there are two. One is the Nikko AM also, right? Beside the SPDR, right? So there are a number of this, right? I'm just highlighting some which are like in Singapore, the popular ones, right? Being looked upon by the investors. So actively, now I mentioned, instead of the traditional passively ETF, now also fund managers are putting up more actively managed ETF, right? So where they can actually seek better return, because for passively managed ETF, like those that want to track into, let's say, STI performance, basically the fund managers don't need to do anything. They just need to buy into the 30 stocks. It's the same stocks that constitute the STI, and leave it alone and you get the return, right? Even if you, let's say, you know one of the counters or one or two counters in this STI is not going to do well. They already announced some bad news. But you cannot go and sell it and switch to the good ones, because you will not be able to track the STI performance. Your duty is just to track the STI performance up or down, right? Whereas if you are the actively managed ETF, the fund managers have the authority or the mandate to say, oh, it's known already, this one is not good. So I take out this and substitute by other good performance, high value ETF stocks. So it will boost the overall return, right? And of course, for that, when they are actively managed, then your fees will be higher. But of course, your fees higher, hopefully they perform better. A number of investors, I mean, we often hear from them, I talk to them, it's like, sometimes, fund managers also, you think they are very good, but they cannot beat the market, right? So sometimes when they choose certain counter in the funds, it actually perform in the short term worse than the indexes, right? Then the investor will say, I pay you higher fees, and yet you're not performing better than even the indexes. I must well go and buy the index ETF. Don't have to pay you the fees and yet better. So by right, a good fund managers or mutual funds, when the market take a turn, to underperform, they of course perhaps cannot also beat the market, but their fund should actually lose less money than the indexes. Then is a better managed or not is a better in terms of performance is better than of course the indexes. It is expected because you manage it, right? Yeah. So actively manage ETF, try to achieve that as well. Now, so this is just a chart that compare the ETF types, right? What is the difference between active and passive ETF as well as active mutual funds, right? So, of course, you see active mutual fund and active ETF, you want to try to outperform the market, right? Whereas passive cannot. I told you, you just follow the index and rely on the active security selection of funds, correct? Which is the case for active managed funds. Track an index or popular benchmark, right? So in the case of active or whatever active mutual funds, they don't, whereas in passive, it is the case. Uh, Track or one or more indexes, yes, and then can be sold short because ETF are traded on the stock market, right? So therefore, it can be traded. So you can also be sold short. So when the market coming down, they have the fund managers have the ability to sell short. So they don't need to be only one-sided, always buy, buy, buy. They can also sell, even they don't have the stocks, they can have their own mechanism or borrow stocks to sell. So they can actually try to beat the market rather than hold on to it or sell at a loss. They actually sell on the way down. They can short sell. They can also purchase on margin, right? In the case of ETF, because it's tradable on stock exchange, and also they are more tax structures wise more efficient. And in terms of cost, you can see passive is the lowest, right? Whereas active ETF a bit moderate, where active managed fund will be high. As a gauge, but it's not the case. You have to look at each ETF. Passive ETF basically could generally be lower than 1%, right? Your funds, you need to pay the fund managers 0 point something to even 0.5, 0.1 to 0.5, very low because they just don't need to do anything. They just manage and invest their funds in the constituents of the ETF. Whereas active ETF, of course, they got to do some work, so it's moderate. They charge the fees are moderate. Whereas active mutual funds, yeah, they will charge the highest, can be from 1 to, wow, even as high, well, I think 1 to 3 lah, but they sometimes also can be higher fees. But of course, at the end of the day, they better deliver, Okay, in terms of risk return, right? You can see where does ETF stand? ETF is basically in the middle, right? Right? Like unit trust, REITs, and ETF, right? Because of the diversification, they are not going into one particular counters. They in a basket of securities. So generally, it's actually even lower than stocks and share, where you go into one. There's a concentration risk, right, of buying into certain counters, right? Of course, when you talk about risks, high up on the very top, beside hedge funds, private equity, also, as I mentioned to you, crypto, which is very risky, right? So next, we go into the structure of the ETF. This one is not that important, but I just also highlight to all of you. Let me just take a quick look at the time, whether, oh, 10:48. Oh, okay. I think should still be fine. We're still about halfway through, more than halfway through. We should finish at 11:30, right? Understand. So again, please stop me, use your video and stop me if you have anything that you're not very clear. Hey, the screen is not moving again. It seems to be. What happened today? You see the same screen, right? Okay, the type of ETF. Oh. So all of you, I hope you got it now, right? The structure of ETF, right? Like I say, ETF got two forms. One is using cash, right? To replication method. One is synthetic replication. Cash basically means you, like the example of the STI, I told you, right? There are 30 counters. So the fund managers basically buy into the 30 counters, right? Let's say DBS is actually one of the largest. UTPS constitute 15%. So they use 15% of the fund buy into DBS. Let's say OC is 10%. Then you use the fund buy 10% to UOB, OC. And let's say Sembawang only 5%. So the fund will buy 5%. As the same as the composition of the SDI. They use the cash. So it's the direct cash replication method. Right? So basically that for sure it will reflect the performance of the STI. But of course, if you have, let's say, S&P 500, wow, 500, you cannot go and use the fund and buy 500 shares. So they will choose which are the key stocks that basically always influence a large part of the price. So depend on the fund managers. They will take a selection of stock, the actively one and the one that actually cause basically the same movement as the indexes. So it's called representative sampling, right? And that's why it's very important. At the end of the day, the movement may not be exactly, except in the case of using full cash replication, at least you're very close to the trend of that particular index when you use representative sampling. But in the case of synthetic replication, it's more complex. That's why we highlight this is that when you buy the ETF, look at how this ETF is being tracked. Is it using replication method or synthetic? Synthetic, basically, they make use of derivative. Derivative are complex equipment like swaps and all, right? Which I explain briefly in the next few slides. They use swap, that means mechanism such that they come out with basically the same, hopefully the financial product will come out with a result that the movement returns will be similar to the indexes that you want to emulate or track. So as a result, it's more complex and the risk of not able to follow the trend is higher. And when I explain the synthetic method, you will probably understand better, right? So the only difference, only thing for you as an investor is to try to find out, well, what type of method they have, right? And when you use synthetic replication method, the risk is higher, right? Now, here just to repeat, the full replication method, where the ETF holds all the asset in the underlying asset in the same proportion, whereas the representative only hold one or some of the particular stock, right? The aim is to track it as close as possible. Whereas in the case of synthetic, they do not hold the underlying stock, the asset. Instead, they use to rely on derivative or swap contract like promissory notes and all to achieve the desired return of the underlying security. Therefore, it's more difficult to sometimes track accurately. But when they use synthetic, is particularly because restriction for foreigners. They can only, if investor interested in it, they got to use this type of methodology, right, to basically use to track. Okay, so the key point is they are more complex and come with greater risk. So there are two examples here, right, to explain to you on this swap mechanism, right? One is basically is an unfunded basis. So these funds, these ETF funds, basically will buy into a basket of security that may not be similar or correlated to the particular index. What they do is they buy this security which they think are sound, and they place it with a custodian, right, for which they get certain returns. They can, let's say, okay, buy into some government bonds, right, different government bonds, which is unrelated to the, let's say, the shares they wanted to buy into. The indexes, let's say STI, instead of buying the STI, which are shares, they buy into STI bond. Then they hold this as security because bonds are also pretty more secure, right? Then they will do a swap with a counterparty, another financial institution, for which they will pay the returns of this basket of security to the swap counterparty, right? Another financial institution. And that financial institution basically will promise to pay the certain return, the exact return of the, let's say, the STI to the ETF. So the ETF basically get the same return, right, that they want to achieve, but they let the other counterparty take on that particular risk. So in doing so, there is a counterparty risk, right? What happens if the counterparty cannot deliver, right? So then it runs a risk. So basically, that's why this is more risky. But of course, for the ETF fund managers, they will also need to know to assess two things. One is their basket of security in which they buy to pay to the other party, and then the other party also would, you also have to take on the risk of the other party, the ability to pay on the promised return, right? If not, then basically you run the risk of a shortfall there. And similarly, the other risk is what happens if the asset that you bought also you think is good, the stocks composition, one or two of them go bust, then the ETF value will also drop. Okay, so this is in short the key risk. Then just now is the unfunded. Now is the funded issue, funded structure for ETF, where you actually take all your money, right, that you have raised, you pass to the counterparty and let him manage the financial counterparty. Then the counterparty will place some collateral, which you look at it and the fund manager will look at it and assess to be adequate to cover, because you provide the fund to them, so that they give you the assured returns under the basically the index that you promised to your investor. So this is another mechanism. Again, the risk is that the promise rate and also the rate that you get under the collateral, whether covers matching or not. And secondly, also even the collateral that you hold, right, that the counterparty has given you, whether it will drop in value or not, right? And the risk of the counterparty failing, right? So this is definitely more complex. You will not, I mean, to be frank, most people will not look into such great detail. They leave it to the ETF fund managers to do it. But if you look into your ETF and you know that this is basically a synthetic replication method, then the risk of such structure will be in place, unlike the cash replication method, right? So here we're talking about the open end and structure, which I mentioned to you earlier, right? Hang on. See, in this open-end structure ETF, one thing we highlight also is that sometimes the ETF is very popular, right? Where the demand is more than supply because people think that this is a good ETF, so they buy into ETF. Then you will end up with a shortage of the ETF shares. Then if there's a shortage, the ETF price will go up so much higher that it may be higher than the performance of the indexes that you want to track. So in this case, the authorized participant, which is the under the ETF issuer arrangement, what they can do is that they will create more shares, right? Once you create more shares, you will normalize the price, right? Such that they will issue enough shares, such that they will make sure that this at least the overall performance will be in line with the indexes they want to track. Okay, so that's why this open structure where they can issue more shares have this flexibility. On the conversely, when there's excess supply of ETF, when people don't want to buy the ETF, that means then what to do, that these authorized participants are allowed to reduce the share by way of redemption. So they'll buy back and then sell it back to the ETF issuers, right? To again normalize the price. Okay, so this is just to explain to all of you some of the mechanism of the ETF, such that at the end of the day they be in line with the particular mandate or the track, particularly the performance of the indices or the return that they kind of promise to investors. Okay, the risk of swap-based ETF, I already highlight to you earlier, right? Because there are counterparty risks, right? There are concentration risks also, right? Because of these various parties involved, right? Collateral risk, what happens, you give all the collateral that you take on, the value drop, right? Even you buy into certain security package, also those securities, some of which diluted, then it affects the value of the ETF as well. And of course, conflict of interest between the swap counterparties, right? Whether they are related or not, right? So all these things are risks that you should be mindful. How the ETF can form part of your investment portfolio, right? Yeah, I think the problem is once I start moving, the slides are not moving today. Sorry, I better get back again. Okay. So why invest in ETF? For most people, it's a way to diversify into different markets and asset classes, correct? Instead of just buying mutual funds and shares, bonds, you can buy into ETF and also in the different region, correct? Then, of course, your exposure is to performance of an index with a smaller uh, capital that you have, right? So you don't have to go and spend so much money to buy into all the other counters, right? You buy into ETF, is representative of it. And you can buy in a very small unit, correct? Like gold, so you don't have to buy the whole physical gold, you got to buy a whole bar or so you can break down into unit, and also it's tradable, right? Because it's transparency, because it's traded on the stock market, and the transaction cost is lower. So are ETFs suitable for everyone, right? So like all investment, there's also a potential risk of capital loss Can you afford to lose a substantial amount of capital? Right? You have to bear that in mind because every investment carries risk, right? Of course, depend on nature of the ETF that you want to go into. If you want to go into high-tech funds, you want to go into all these different markets. Yeah, it's the same, right? The investment risk will be depending on the financial product or the areas that you want to invest. So do you understand how the returns are determined? Are you clear about the factor that affect your return? All these things you have to bear in mind. And of course, like I said earlier, the risk associated with synthetic and swap-based ETF, right? And generally also ETF like bond mutual funds, you don't trade in and out that often, right? You basically ride on it for long term. So you have to look at it when you invest in it on a longer term perspective, particularly when you choose. Because as cheap as it is, you also pay a certain fees, right? Are you familiar with the ETF manager and the ETF performance track record? Also very important because ETF can be structured by mutual fund by various fund managers. So you have to look at the fund manager's performance, for which you can also go into the ETF chart itself, that particular area, that particular ETF, and look at the performance over the years, short term, 1 year, 2 year, 3 years, or even a few months. Few months may be a bit too short because like in all fairness, like I say, this is a long-term return. So you actually look at it 1 year above, 3 years, 5 years. Is this ETF fund manager doing well? This particular ETF funds doing well? That's how you look at it and use historical performance as a measure before you decide whether you want to choose that particular ETF by that particular ETF manager, right? Because there are so many different houses, financial institutions that sell ETF in the same team, in the same area. So you can choose. Just now, like the STI, SPDR as one, Standard & Poor's like SPDR, and then the other one is Nikkei, right? There are two ETF that basically track the STI indexes, right? What to watch out for, right? So earlier, we already mentioned market risk. When you invest, because market risk is basically something that when you invest, you can look at it, something not the counter itself, the performance of the economy, geopolitical risks, development can change. These are market risk factors. Tracking error, right? Because if you invest in ETF, basically you want to track certain performance. So you see how close this particular ETF is, moving in accordance over time according to the indices that you want or the performance of this sector that you want. So it's a way, if the tracking error is always very high, then it's not a very effective instrument, right? Or this particular ETF. The counterparty risk, which I already mentioned earlier. Of course, there are other things like foreign exchange risk, because if you buy into a US dollar ETF, then you have this foreign currency risk or Hong Kong dollar. At what price you convert your Sing dollar into the US dollars, right? There's a foreign exchange risk. Liquidity risk. Is this ETF very liquid? Or you got to look at the volume also. If it is very illiquid, very lowly traded, not many people interested in it, then when you want to sell, you may not necessarily find a good price because the buyers are so limited. Once you start selling, the price will drop a lot, right? ETF traded price not reflective of the NA value, right? It's because of the poor tracking error, or basically the ETF fund managers are not able to adjust it, right, well, to reflect the true NAV value. Like I said, sometimes they have to create more shares, sometimes they got to buy back. So to which the fund managers is also important. Tracking error, right? Yeah, tracking error, just I already mentioned, is the difference in return of the ETF and the index being tracked, right? So the best ETF with the low tracking error, right? That's basically what the investor want. Large tracking error is usually presented for illiquid market or for illiquid index constituents, or using derivative complex kind of swaps that basically not representative, right? So the investment strategy for ETF, all of us, basically is a strategic allocation, right? Usually for longer term, you hold out. It's a core satellite investment, right? Then what you need to do is, yeah, it is basically also kind of a risk management tool for hedging also. Some people use it for hedging, and some also use it for active trading because they think that, oh, it's also, but those are, then you must look at the ETF whether they are highly liquid or not. So you can trade in and out, right? Because if they are looking at certain sector in the short term, or it's going to go up, but instead of cherry picking, you can also buy the ETF, right? And then, well, because it's lower fees and all this, you can buy and sell it, uh, even for trading. But I would say most of them more will be looking at more for buy and hold and for a bit for the longer term. And how to select, right? See ETF, right? I'm sure all of you are interested in this area as well. After already given you all the earlier concept, basic concept, right? But before you invest in ETF, like you invest in shares and other financial product, it's actually very important to know what's your investment objective, right? Your investment objective is, yeah, also depending on your risk profile, your investment horizon. With all this, then you formulate your investment strategy. Because your investment objective, let's say, is to go into a pretty safe return of 6% or 6%, then perhaps if you go and buy into high-tech US stocks, it's going to give you much higher return. But similarly, it can also lose you more money. Right? If your investment objective is based on your risk profile, also, I think I want to have a safer bet. I don't want to take too much risk. Then perhaps you should look at an ETF that's maybe more in fixed income product, right? Like bonds. Bonds also high rated. Those are good credit bonds, good top corporate bond or government-owned company bonds. Then your return maybe will be lower, could be even to 4 to 5%. So that all this will determine on the type of ETF that you want to purchase in. Yeah, your investment horizon also is like if it's long term or versus short term, then you will look at, obviously short term, then I want to get back my money, then you also have to kind of profile what type of investment. Because if you go into something that is basically long term, then likely the result will turn out, then you have to look at the prospect of that ability of you to make the type of return in the short term, and you get back the money at the end of, let's say, 2 years or 3 years, right? So all these are consideration of investing, right? Not only in ETF, but in all financial products as well. So for ETF, basically, you got to look at the underlying asset class or indices, right? Like I mentioned earlier, you want to buy in ETF of top corporate share, top corporate bonds, or commodity like gold, right? These are different asset classes, right? All on certain indexes. Then the size of the ETF is important to determine your liquidity. Bigger ETF size basically give better liquidity and also reflected in the trading volume, right? The structure and the risk also, I said, look at it. Is it cash-based replication or synthetic replication? And also look at the tracking error over time. They also have all this data's information in your fact sheet of the ETF and the current and the expected market condition. Sometimes obviously not that you can time the market well, but if let's say the market already over bullish, already close to all-time high, then you have to assess, right? Is it the time to buy it, right? Comparison using SGX ETF and the screener, right? So this is some I've mentioned to you earlier. You go to the SGX site and you go to security, you go to ETF screener. This will throw out, right, this particular sheet, and then where they will list out all the various ETF traded on the Singapore Stock Exchange, against which you can all look at all these things to get to search, and the search on the right hand side, you can actually look at the fund managers, the geography, the benchmark, right? The asset class and the classification, right? What are the areas that you want to look at? You search into all these areas. What are the fund managers that are available on this ETF? On the ETF that you're interested in, geography, which area, US, the benchmark also on what particular area, segment, asset class, bonds, shares, right? So all this you can try to go into it, find out more, right? And investigate. And if you're not familiar, then of course you consult a financial advisor if you have one. If not, today, of course, everybody can use ChatGPT, AI to go and read up and find out much more, right? So understanding ETF, right? Basically, I'm expanding this screen and showing all of you, right? Now, what are the fields on the beside the particular ETF? And to just sum up on the SGX screen, let's say like this Lion Philippe S-REIT. This Lion S-REIT ETF basically is an ETF on Singapore REITs, S-REIT Singapore REITs. So they buy into various Singapore REITs that try to give the return of basically the Singapore REITs indexes, right? So if this year the STI, the REITs in general, right, whether you invest in capital escort REITs or CDL hospitality REITs, or this other Maple Tree logistic or Maple Tree commercial, right? So they invest in a number of this, and basically they try to get a return similar to the S-REIT overall return. So here you see what they do is you look at a turnover also as a reflection of the overall trading volume. The higher it is, the better, right? The year-to-date return will reflect the overall return since the beginning of the year. So since the beginning of the year, and this one is a bit outdated, so don't just read. But I'm just giving you the what actually it says you should look at. Year-to-date return is 2.19%, whereas the dividend yield, because the year-to-date rate return also include all the whatever interest return, dividend return from all the REITs that they invested in. You see, the dividend return is pretty good, it's 6.89, right? For REITs, it's basically they have to pay out all the cash after paying out after expending all the expenses. So you see, the dividend return in this case is higher than the year-to-date return, which means to say the value of that REITs actually came off. The price came off so that it lowered the overall return. Because particularly now, as you know, the REITs also performance not so good because interest rate in the past has gone up and it still stay up at a relatively higher level than before. Right? And also the prospect of some REITs are not so good, like the retail REITs and some of the office REITs. Office REITs generally okay, but depending which tier, right? So it can affect the value of the REITs as a result, right? Like office REITs in US is not good because people are not returning to office yet. But now once you return, then it's better. And the interest rate also, is still high. So it affects the value of the REITs, right? Year-to-date performance, not so good. Then expense ratio, as I mentioned to you, is the basically the cost to you, right? So the lower it is, the better. So, and then you look at what are the area? Like this is basically equity, right? Invest in equity. Or in fact, all here, unfortunately, all show equity, but there's of course those bond REITs also, right? So it depends on what class. The EIP and SIP, is basically classification. In Singapore, basically, you look at this, EIP, MES basically means when EIP is called excluded investment product, which means this product basically are eligible to retail investor. They are less complex. So you classify EIP, you can buy in. But SIP, there are two of them, right? The SPDR, Dow Jones, US dollar, and 500 is SIP, right? SIP means they are specific investment product, which means to say only those accredited investor can buy in, right? So for your, if you go to certain the houses, they will do a rating for you, right? Whether you are called accredited or not accredited, right? So general retail, you can buy EIP, but not SIP. Okay, so these are some things you can take note, right? And then the other thing, of course, is that from this ETFs screener on the SGX, also you can find out much more things, you know. You click on it on any of this particular counter, like STI, ETF, then they will also shows eligibility of prospectus, monthly report, production highlight sheet, semi-annual report, annual report, and annual report. So all these are important information documents where you can actually find out much more about this particular ETF, right? In their mandates, in their performance, right? So this, and most of them have also, to make it easier, like EIP, they actually don't need to, in fact, come out with a full prospectus. They give you a summarized spreadsheet, highlight sheet, like the one below here, which give you all the information that you can actually look at, right? So the more you look at it, the better. Of course, some of them will say, okay, it's good enough. I don't want to cover, I don't want to read the whole prospectus. It's so thick, you know, I mean, which I read. So you look at the highlight sheet. And then, of course, with certain things that arouse your concern and clarification, then you can go into the prospectus and read in detail, right? So, like I said, if you look at all this product highlight sheet, this will all be provided. All the information, in this case STI ETF, you have the product type, the manager, the sub-manager, right? Expense ratio 0.3, right? Then when was it listed? 2003. So you see all the informations are there, right? From here, then you go into the detail, the product suitability. They even tell you what are the key product features, right? The investment strategy, the party involved, right? What are you invested in, right? What are the key risks, right? They even highlight to you. Right, but obviously, yeah, you can go into it. Like if you go in STI ETF, basically, of course, any of the counters inside this top 30, if they have not performed well, it will affect you. The general economy of Singapore, which will also be market risk. So read into greater detail of all this highlight spreadsheet will be very useful for you to have a better understanding. And when you talk of risk, then they will highlight, wow, many risks, liquidity risk, product risk, specific, right? And of course, very importantly, also you can look at the fees and the charges, okay? How much, in this case, the expense ratio is 0.3. What about any upfront fees? Because if you are buying from let's say the fund any of houses, they will charge you also upfront fees, right? Beside these manager fees, which are basically already built into the price at the time you buy in, right? So let me see the time again. Okay, we still have about 10 minutes. Okay, should finish soon. So here, after I've spoken to you and then you look at this, of course, if more time, I would have asked all of you to give up your view, but maybe 10 minutes, I'll leave some time for your Q&A. Now, the liquidity and expense ratio, this basically two things. One, liquidity, you look at the turnover, right? Whether this is very active or not. Like in this case, STI ETF, as I said, Singapore not that many, very popular. The S Street also popular, 200 over 1,000 per day. Nikko is also one of STI. These are the popular ones, right? SPDR, S&P 500 less because US dollars. Then China even lower, 190. I think this is 190 share. So this one is basically, you can see below on China stock, probably less interest now, right? And you look, it's only in terms of volume, so the liquidity is low, no? Be mindful of that, right? Then you see the expense ratio, right? The cost, right? The expense ratio, to manage China stocks, probably the fund manager will charge more because of the difficulties in managing it to find the right stocks, right? Even in tracking. So whereas of course in terms of the STI ETF is quite easy, so they are very low. Not to mention the 500 even lower, 0.09, right? Because it's very established already, they're able to track it pretty confidently. The cost is very low, right? And then you look at performance. When you look at performance, then you look at the year to date, right? Up to now, the return since the beginning of the year, right? Which one is doing well, right? Wow, of course, the US market, as you know, this one was last year, I can tell you. The last year, the US market still continue to do very well. Actually, 19%. In fact, those who invest, Singapore market is basically pretty stable, so you don't get the type of return. But even in shares, not too bad, right? You get, of course, STI, you only get it's close to 3% only. You see both STI ETF only 2.72 and 2.45, right? Basically, since the beginning of the year, it reflect the STI, right? So like the Singapore economy, right? Performance 2 to 3%, right? So you will want to look at return, then of course performance, you look at year to date, right? Then complexity, you see, right? In terms of here, it's not like you go into each one, you can find out how are they replicated. But in terms of complexity, you can use EIP and SIP, as I mentioned to you earlier, right? EIP, retail can, SIP, only accredited investor. And then category-wise is whether they are equity or they are bond, right? So you can find out from here the simple, based on this, right? Asset class is shares. So yeah, you can have this template and build more into it to find out more, right? Before you jump in. Okay, so with that already, let me see. We already finished the talk, and I just want to test if you all really grasp. Now you can actually go to your chat box and let me know what's the answer. When investing in ETF, what we need to consider? What is the answer? 4 items. Yeah. Sorry. Before that, there's one good question. Why are there two different STI ETF, SPDR and Nikko? This one actually I answered earlier. In fact, you see, STI is indexes. There are so far two. These are very established. Standard and Poor and then Nikko. I say there could be other party, that want to come in and formulate, but these two are quite established already. So it doesn't mean that why are there two? It's up to the fund managers, right? Whether they want to set up ITF and they have enough investors, correct? But they basically are coming in with the same objective. So these two basically are trying to track the STI indexes, nothing more, nothing less. It's not that they are, but many more may come in and do the active ETF, let's say on Singapore top corporates and all, and they will try to achieve better return than the STI so that ETFs such that they can attract investors, right? New investors who come in who want to seek higher return and yet investing in the same particular area. Okay. Okay, now good. Sorry, let me just pull my side, my question Q&A. Okay, for thanks, Serene. 4, all the above, right? Investing. Synthetic ETF is a what product? simple product, a complex product involving derivatives suitable for novice investors, all of the above. B, thank you. Wow, all of you, yeah, very good. Okay, next, ETF offer the following: diversification, dividends, intraday short trading, shorting, all the above. Number 3, which was the answer? Actually very simple one. Yeah. Yeah, good. Thank you. Jie Ying and Sandra. Most ETF are passively managed and tracked and indexed. True or false? Definitely. Definitely true. Okay. Okay, with that, actually, you see, I finished the talk where basically during this 1.5 hour, it just give you a brief introduction now on ETF, which is a useful investment tool for investors with a long-term investment horizon and happy with benchmark indexes return, right? That has been well repeated. ETF are lower cost for investors and offer in advantage over the mutual funds, right? Because basically that they are less actively managed, so they got lower cost. And what you do is that when you need to do your research understand the ETF investment strategy, return, risk, and fees, expenses, and then you read into their documents, right? Because it's a composition of products it depend on the asset class that you want to invest in, right? And then you can consult a trusted financial advisor before investing. Because today there are many thematic funds. You go into RoboCop, Stash Away, but those are like mutual funds also. There are some, but you also should have ETF. So you can actually start small with some of this to get a better grasp and understanding, right? So it's a very useful product that all of you should find out more, right? Start small, find out more, and then dabble into it, not jump into it without knowing. In investing, it's that don't hearsay based on what people tell you, right? So, okay, besides that, I would also like to highlight that, while we talk today on a financial product, we also have these basic financial guides, that help you to understand better in terms of other areas of financial management, financial planning, like saving, insurance, retirement planning, investment, the 4 key pillars that what IFL has advocate to share with all of us, the public, right? So you can click on this QR code and then get all this financial planning guide. Give you the basic, and then you want to find out more, you can attend our talks on this particular topic, or of course, further your knowledge into, but through, of course, self-study or go into today into the website and find out much more, right, in the areas that you are interested in. And these are also some of the links that would naturally be useful. Money Sense, IFL itself, CPF board, stock market, right? This I need. So at the end of the day, yeah, I'm sure you're familiar with our Finland. You can actually find out what are the programs, talks that we are hosting. And lastly, I would need all of you, your kind cooperation and assistance to go into this survey, right? Survey, it doesn't matter whether right or wrong. What we want to do is basically for you to have your feedback, right? Such that whether how today's session on this particular product, how can we improve on it, right? And then we can basically, collate all your findings, right? And then we provide to our sponsor. Now, after the survey, then you'll be able also to download the PDF training slide that I've posted today, right? My apologies again on the 2 videos. I think sometimes these technological issues, whenever I play the videos, it gets, all this kind of downloading issue, right? My apologies, but hopefully from the slide presentation, I can, because basically it's the same. I just want to reiterate what have been already provided, but those are short videos. So, okay, with that, can you please, right, click on this QR link, right? And then because you're already logged into your account, right? And then use this QR link. And the step 2 is to go to the menu and choose the course ID, type in this course ID, and then third is go to the dashboard, understanding ETF, and you can start the survey. And once you are finished, I appreciate very much you would put the word done, so I know roughly, yeah, you have completed the survey, correct? And in the meantime, I will look again into the chat box if there are any questions, right? Feel free to raise. I mean, it's a small group, right? No worries about right or wrong. And in the course of this survey, yeah, I would also like to highlight to you, yeah, there are things like called strongly agree and strongly disagree. Sometimes some of the participants kind of confuse the word strongly disagree, but most of the time, if you think it is right, then it should be strongly agree, right? Because we have received feedback. Cannot. I mean, of course, there are cases where you disagree or strongly disagree, but please don't mix up the two, right? Any issues can bring up to me because we need your correct feedback, right? Otherwise, it distort the actual reply. So yeah, spend a few seconds, or not seconds, minutes to just complete it, and I'll be around here, right, to answer your question. I'm looking at the chat box now. If I miss out any questions that you all have posted earlier. Okay, the why are two tough PPF. In case you play the, oh yeah, that's right. Okay, so far there's only that question now. Yeah, I mean, I'm sure it's it's a topic that you would like to find out. So if you like to uh, know more or have any inquiry, put in the chat box. And once you have completed the survey, just put a word done. And those who really need to rush off and or you really have other engagement, just feel free to leave, right? Okay, thank you very much for those who have done the survey. Right, thanks. Hope my short talk I give you some good introduction, right, to ETF, and you can actually venture more into it. And a happy New Year to all of you, those Chinese who are celebrating the Lunar New Year. For the remaining ones who are still doing the survey, take your time, right? Even you don't need to rush, but of course I appreciate you can submit them. Okay, if there's no question, right, I will also take leave and stop the today's presentation. Again, thank you very much, right? But those who have not finished the survey, even if I shut up, close out, you can still continue and finish with it and submit, right? And we look forward to see you again in our next talk, right? That is of interest to you, right? Thank you again very much.